Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and I hope you had a very happy 4th of July yesterday. We spent a good part of our day barbecuing with our neighbors and friends, and it was a lot of fun. I hope it was for you too. Now, before we get into the analysis of the market here, we had a shortened trading week, obviously. I want everyone to know that I continue to follow the 7-point trading checklist. And if you want a copy of this, just contact us over at StickyTrades.com. We can send you the PDF document, or you can sign up for a free 15-day membership. No credit card needed at all. I want to make sure we stress that point because a lot of times people are skeptical about that credit card being submitted. We don't do that. You can just set up your free membership, try it out, and then if you like to stick with us, of course, you're welcome. The fear index is starting to drop. What does that mean? Well, a year ago today, we had an extreme greed reading here on the fear index, and it's been steadily dropping. You can see a month ago it went from 91 to 88. A week ago, it dropped pretty dramatically to 65. And we're currently tracking a 57-point reading on this fear and greed index. You could just Google this. It's dynamic. You can get that reading each and every day. And the reason I point this out is because greed is what drives prices higher. And these are monthly charts of some of the most popular mega cap stocks out there. You can see Apple, Microsoft, Google, all going vertical in their parabolic price action here. You see this Apple. Eli Lilly is giving NVIDIA a run for the money with an almost vertical move here. And that is what drives prices higher. It's greed. People get involved in the market. You got people fearing that they're going to miss out on the next big profit move. And while these are monthly charts, you have to understand that, as I just mentioned, the greed is starting to subside and fear is about to move into the market. Once we start dropping below 50, then fear starts to come in, the volatility index starts to rally because that too is known as a fear index. And then what happens? Well, we generally get big drops. When prices go vertical, they tend to drop in a vertical way as well. And I'm just pointing that out because if I were on the beach sitting in the lifeguard stand and you were out there with the waves starting to kick up, and there was the threat of a riptide, for instance, I'm sure you'd want me to at least blow the whistle to give you the warning. Well, that's what I'm doing here in the market. Remember that 95% of our positions that we've been putting out through the trade publications have been bullish. We've been doing extremely well with that, but I have to continue to wave that caution flag because the signs are starting to come in a big way. That fear is beginning to creep its way into the market. Now, looking at today's price action, remember that we have this little bit of a candle right there that's known as a hanging man. A hanging man is a small body candle that has a shadow below it that's 1.5 to 2 times the length of the body. And when found at the end of an upward leg like we see here, that's generally bearish. So I'm keeping my downside target. Again, it hasn't really moved from 382.20, and that's mainly because we're stuck in this range right here. And if you look down below, the CCI, as I magnify that, is starting to hinge lower. That's telling us that the sellers are starting to move in to the Dow. Now, with regard to the small cap stocks, looking at IWM, you can see that we are slowly getting down to my downside target there of 198.05, and we've now crossed below that 20-period moving average. As a result of that moving average being crossed, you can see down below the CCI has now crossed below the momentum line. That's a black line known as the zero line. And once that crosses, we generally get 2 to 4 more days of downward momentum in the direction of that cross. You can see back here, when we crossed below, we had about 3 to 4 days of downside action. So I'm expecting the price to continue to the downside. That's why I'm not moving that downside target right there on IWM at 198.05. Looking at the Qs, which is obviously tech heavy, we have a handful of stocks still driving prices higher. But look, we have a slight hinge on that CCI. Again, that's one of the highest readings we've had in years. If I even go back and look at a 4-year daily chart here, you can see that the CCI is one of the highest readings that we've had in 4 years, and you can say the same for the stochastic. So those are extremely overbought and starting to hinge again with the CCI, and I think that could trigger a pivot point into next week. I'm still keeping my downside target. While some of you might think that's extreme, my downside target is still set at 455.89. Now, looking at SPY, you're going to see something similar. We have the hinge forming there on the CCI. We have an overbought reading on the stochastic. Downside target on SPY is still set at 527.07. If I look at the monthly chart on this one, you can see again we have a pretty wide divergence from that 20-month moving average. The markets do not like to stay that far away from that moving average. So I'm expecting this whole down leg here to repeat. I've said that a couple of weeks ago. I do believe that we're going to pull back. So therefore, if you have any long positions like we do, I would suggest that you spend a lot of time managing risk, or at least, at the very least, protecting profits on those positions. And so that is SPY. If we look at the VIX, very interesting thing happening here. We have a hammer candle. That is a long shadow underneath that small body of a candle, and that's usually bullish. That is as bullish as an inverted hammer like we see here. And when you see that long shadow underneath that hammer right at a key support level, that is telling us, again, fear is starting to creep in to the market. The volatility index is a more dynamic indicator of fear creeping in, and a lot of people call it the fear index. And so when you look at that coupled with what we see here in the CCI with it forming a buy signal, see how it crossed over that green line. Let me condense that scale so you can see that. It went down below, oversold, it crossed above today. So we have a buy signal on the CCI. So I believe that the VIX is going to start moving up. My upside target on the VIX is 1362. Interesting thing I want to point out here is Bitcoin. Take a look at what's happened here. We bounced perfectly off of this role reversal support level. If you go back a couple of weeks, and you could even check the description box below for the link to role reversal, that's when former resistance is broken, it tends to act or revert back to support. And that's what we're seeing. So I still have an upside target on Bitcoin at 66,000. And you can see that the CCI down here is the third lowest reading in that oversold area of the CCI. So I think that you're going to see a little bit of a bounce in Bitcoin. So for those of you who are trading, let's say Mara, Coinbase, Ethereum, anything that is related to Bitcoin, you might find some pivot points forming at key support levels. So keep your eyes open for that with regard to trading opportunities. So I just want to mention that. And also, I want to point out silver. Very interesting thing happened with silver today. We had a gap up, but as I analyzed this last Wednesday, I have a downside target on silver set at 27.17, but that was contingent upon a drop in volume. So for those members out there that are waiting for that pivot, you have to understand we need to see a drop in volume first. I think we could see that Monday or Tuesday. It's very difficult to forecast what's going to happen to price, let alone volume. So keep your eye out for that volume drop, and you can see that we have a hinge on the CCI starting to form. A hinge is different than a pivot. A pivot is when it starts actually heading lower. A hinge is when it starts to change direction. So we're seeing that overbought condition in silver with that hinge. So stand by. I'm a buyer down below on SLV. I'm just waiting for that support level to hit, and then I'll be back into 100% position. I have a pretty hefty position in silver already, just to disclose that to the public. So a day like today did not upset me one bit, but I am looking to buy more at the lower levels. All right, let's go back to the economic news now. You could see that U.S. consumers have exhausted their savings. Now, that is a danger sign for the economy, because when the consumers, i.e. the buyers of products that sell in the retail stores, when their buying power is exhausted, then guess what? The economy suffers. And as a result, GDP winds up dropping. So we're seeing the beginning signs of that recession creeping in. Keep in mind, we need recessions. You can't have a booming economy all the time. Recessions help bring down inflation, believe it or not. When buyers just don't spend, the retailers and those who have strong inventories have to lower their prices to move that inventory out. And so that actually helps bring inflation back into check. So it's not something that should be feared, but the markets tend to sell off during recessionary times. And that's why I continue to wave that caution flag. If you take a look at what's happening as a result of consumers running out of buying power, well, they're maxed out on their credit cards. So what happens after that? Well, bankruptcies tend to follow. So we're seeing bankruptcies on the uptick. Remember, the blue shaded areas are year to date right through May. So we have a lot of year left for all of this orange/amber color to start to build up throughout the rest of the year. So keep an eye on that. It's something I've been reporting on for months. Doesn't surprise me one bit that we got an uptick in bankruptcies. But again, it's a leading indicator. As far as factory orders, well, they took an unexpected turn to the downside in May. And that too is another sign of recession. If factory orders drop, that means product is not moving. Therefore, prices have to drop to make them more attractive to the consumer. And you know how it goes, especially if you paid attention in economics class when you went to school, right? Remember micro and macroeconomics? Well, it's pretty simple. Supply and demand drives our world. And if there is no demand, then supply increases, price drop, and that's just the way it goes. Now, as far as job openings, you have to understand that a lot of the government jobs are doing absolutely nothing to stimulate our economy. It's just another form of wealth distribution. And the private sector job openings are absolutely crashing. You see here, this is the red line that I'm talking about. We can see the job openings in the private sector have a pretty wide divergence from the government jobs, and eventually that will turn. But remember, we have to pay more attention to the red line than the green line, because the government can create jobs just by waving that magic wand. But again, it does absolutely nothing for our GDP. Construction industry is suffering the largest layoffs since the crash of 2008 as jobless claims again disappoint. Check out this chart right here. Again, we haven't seen that since the crash of 2008. So another warning sign is out there for you to pay very close attention to. And as I've mentioned, keep an eye on the BRICS nations. Keep your eyes on China. They are about to introduce and open up the first grain exchange. That's going to happen in October. What that will mean for commodity prices is really unknown at this particular point in time. But I do believe that the volatility and price action of the futures contracts in grain, coffee, sugar, cocoa, and the like could get pretty volatile. So if you folks out there that like to trade the futures markets, get ready, fasten your seatbelt. I think there's going to be a lot of opportunity out there. And if you're not familiar with how to trade futures, well, guess what? I wouldn't just jump right into that. I take some courses. Make sure you plug into your broker. Make sure that they absolutely qualify you first before you open up a futures account. You could get stung pretty badly if you don't know what you're doing. So I'm putting that warning out for those of you that are thinking about that. If you go to our webpage, we have the rapid fire stock analysis results. And this is your time where you can put your stocks to the test by just putting in a ticker symbol. Let's say we're looking at Google, GOOG. You can see how many times I've analyzed that stock and the percentage of times I've hit the targets. Google has a hit rate of almost 91%. If you go IWM, which comes up once in a while in our rapid fire analysis, you can see that's 100% hit rate. I don't even know what diamonds is. We don't really analyze those during the rapid fire because I do that on Fridays with the weekly market report. But you can see 100% hit rate. What else can we put in there? Microsoft. Let's see what happened with Microsoft here. All right, not a great result there, but the point is, if you're looking at stocks like Microsoft, or maybe you're looking at Tesla, you want to see what the rate is for the hits. and you can see how Tesla hit 81% of the time. Well, overall, my hit rate is about 83%. And so what I tell people all the time is put your ticker symbol in here first, especially if you're a member. You can set up your 15-day free membership to test this out. But if you're a member, you could put your ticker symbol in there and see what kind of results you get on these stocks. Some stocks do a much better job of following the technical signals while others don't. So doesn't it make sense to stick with the stocks if you're trading that follow the technical signals? I mean, bullish and bearish engulfing candles are very reliable, but if you're looking at all the other indicators following my 7-point trading checklist, like I mentioned here before, it's going to give you a higher probability of making money if you're stacking up all the signals in one direction or the other before you place that trade. Folks, thank you so much for liking and sharing and subscribing. We're building our membership thanks to you sharing on all the social media pages. We really appreciate that so much. Please continue to do that. It really helps us out. And I will talk to you on the next video. So long.